Hi everyone and welcome back to the channel and to another video. In today's video I want to show you a few UK based growth stocks that I'm looking into as a potential investment opportunities. Now I am from the UK, as you can probably tell, but I tend to buy mostly US or international companies and cover US and international companies here on the channel. But these two or three companies I'm about to introduce to you all have great growth potential, are currently compounding at very high rates, have a lot of room to expand further from where they are now. They also operate in fast-growing global industries, these two being e-commerce that we're going to look at today. So they tick a lot of the boxes, and most of the boxes in general. They also earn revenues internationally, so they're not reliant on only the UK. So I think with all that in mind, it's worth us diving in. I do have some more research to do on them, but I thought I would share with you what I'm doing and currently looking at outside of the norm. Now, here are the two or three companies that I'm going to be looking at. The ones we're going to be touching on today are these e-commerce brands, Asos and Boohoo. Both of these companies are online-only retail clothing fashion stores. They both started from virtually nothing and have scaled to billion-pound businesses with various brands under their respective banners. And lastly is S4 Capital, a UK-based digital marketing company. Now, I'm not going to touch on these guys today, but I hopefully will get a separate video out on them doing more of a deep dive because it's a very compelling company with a great story. Also, I feel the business requires some more in-depth analysis than the others. So go and check them out if you're interested. They're a really compelling company, very compelling startup and CEO. But the plan is here with these two, Asos and Boohoo. Hopefully I'm going to introduce you to these businesses today, review their past performance, talk briefly about why there are some catalysts for their future growth and their industries. And then as always, we're going to screen the stock in a forecast and valuation model to see maybe what sort of fair price we should be paying for the stock today, or if they're companies that look undervalued on the face of it. And starting with Boohoo, shall we? Here, I have their website. We'll break down their annual report and results in a moment, but I just want to look at their brands. So at the moment, they're now 9 brands, as we can see here. The main ones being Boohoo and Boohoo Man. You've also got Nasty Gal, which is a big one, and Pretty Little Thing. They acquired Karen Millen, which is a UK fashion retailer as well in the UK. I think they've done that in late 2019. So they are building up a portfolio of brands rather than just the one brand they had existing before. And apart from having, really terrible names, they're actually pretty good businesses. They're supposed to offer unique fashion to 16 to 40-year-olds, all right? They're supposed to appeal to 16 to 40-year-olds and offer, I guess, an alternative to some of the more expensive designer brands or luxury brands out there. They're supposed to be a lot more cost-effective way of being up-to-date with fashion. Now, for all I know about finance and investing, I probably lack in fashion, so I won't make any comments on whether I think any of these clothes or products are good products relative to what I want to wear. But they are very popular with this age group, 14 to 30 years old, especially in the UK. And look, they are a company from humble beginnings. They were founded in 2006 by Mahmoud Kamani and Carol Kane. They IPO'd in 2014, and since their IPO in 2014, they have experienced some fairly significant growth. So revenue has grown from 110 million to around 1.745 billion as of the last trailing 12 months, which is obviously over a 10x in just 7 years, which is great growth to see. They've been profitable the whole time as well on an adjusted EBITDA basis. So the economics of the business are quite sustainable. We can see gone from 16 million to over 174 million in adjusted EBITDA in just 7 years as well. And like I say, for a UK company, and what's good is that I think Boohoo have seen that there's a lot of opportunity just past the UK, right? The UK is going to stunt their growth eventually if they stay here. So they're still experiencing, high 39% year-over-year growth in the UK, but they're also expanding in the USA with 435 million of total revenue in the USA. So the USA is not a small part of their business anymore. That's growing at 65% per year, which is a very high growth rate. And then we've got Europe growing at 30%, the rest of the world growing at 16%, making up smaller parts of the business. I think the USA and the UK will be the real growth drivers for Boohoo going into the next sort of 3 to 5 years. And a lot of their strategy at the moment, we'll see a similar thing with Asos as well. With these retail e-commerce places, they're buying up some of the popular UK brick and mortar retailers that have had a troubled time this year and in the past 2 years. So Debenhams, Burton being one of them, Dorothy Perkins as well. We saw Karen Millen earlier in 2019. But it's an interesting strategy thinking about how they can get some of these legacy retailers in the UK who are very popular, very successful at one point. How can they turn their success back around by investing in technology and turning it into a digital play? I think the fact that they can pick up distressed brick and mortar retailers at a very attractive price and then try and turn their success around, which I think they probably can, I think it's a very good business opportunity for them rather than just focusing on organic growth, which at some point will start to slow. And to just cover their results, like I said, since 2014 really, but this is only showing 2016, they've experienced really, really aggressive growth. On the top line, definitely, 56% is the average over the past 5 years. So very impressive growth rate. Like I say, they've been profitable for the whole time as well. Margins are sitting around anywhere from 8 to 10% on an EBITDA basis, and then around 5 to 6% for net income. So they're not hugely profitable, but remember, this is a retail business where they do have to facilitate all of the logistics, buy all of the materials and products themselves, and then they sell it on for a markup. So it's not going to be a very high margin business ever, I don't think, although they can expand on these margins eventually and hopefully get closer to, say, a 10% EBITDA margin, which is near enough the guidance they've given for next year. And free cash flow, they've been free cash flow positive for the whole time, so cash conversion is key with these companies. How much of their earnings can they actually turn into cash that essentially belongs to shareholders of the business or investors in the business and could be redistributed out to investors or reinvested back into the business. And good to see that as of the most recent year, they produced 152 million in cash flow, which as of their current market cap, which is around 4 billion, is a 4% free cash flow yield. And that's a very good yield for a company growing top line at above 40%. Now, in terms of balance sheet as well, little to no debt, 21 million. We're not going to be worried about that whatsoever. 276 million of cash and cash equivalents. Of course, they do like to make a lot of acquisitions as well, so their growth strategy is centered around buying other businesses like we've seen, but there is going to be some organic growth as well. So they may need more cash going into the future, but the fact that they're producing around 152 million of free cash flow on an annual basis means that that cash pile should start to increase as time goes on and should be able to facilitate any of the acquisitions that they want to make, especially of the smaller companies. But all in all, if we're looking at the valuation for this company, just before we get into the forecast, it looks pretty attractive. Company growing at 40%, selling at a 40 times PE there or thereabouts. EV to EBITDA is 24 times, free cash flow yield of 4%. I've got to say, if this wasn't a UK company, if this was a company in the US market currently, it'd probably be selling for around 60 times PE or around 40 times EV to EBITDA. That's just the sort of premium those growth companies are getting in those regions of the market. So sometimes it's good to look outside of the US, which is what we're doing today, and see what sort of value exists there. So for my forecast, I've gone with a conservative forecast because remember, at this point, we're just trying to screen the stock, right? We're just trying to get an idea of whether this company does present value. Of course, we could just take their previous growth rate of 45 to 50% and then project that out for the next 5 years, but we don't know how accurate that is. We really want to understand the business and have an idea of how likely it is to grow for the next 3 to 5 years, how quickly it can grow, what sort of revenue it can generate in, say, 5 years' time, what's the destination of that company in the next 5 to 10 years. And for Boohoo, I'm not absolutely certain. So what I've done is I've taken the growth rate down to around 25% for next year, then really conservatively dropped it to 15 and then to 12% over the period. So I've actually given guidance that I'll touch on in a minute that shows they should reach 2.1 billion or 2.2 billion for 2022 or next financial year. And for the profit margins, I've kept them near enough the same. Again, they gave us guidance next year they should reach 9.5% EBITDA margin, so I've gone with that and then just kept it flat for the remaining 6 years and then kept the cash conversion at the same amount that we've seen previously. So not a huge amount of improvements, but again, we're just screening the stock. And based off a terminal value multiple of 25 times, which is currently around at the moment, and a discount rate of 15%, it's showing us that Boohoo stock is currently 10% undervalued and that a fair price to pay would actually be £3.56. Now, I know this says $3. It should actually say £3 because we're trading in pounds here, or 4.4 billion for the entire company. The market cap's currently around 4 billion, give or take. So it looks like some good value does exist with this company. And obviously our growth rates haven't been tremendous at all. They've actually come down significantly So you're looking at a forecast which says their average growth rate is going to go from 56% to 15% in the next 5 years. Now, I'll just show you, if we tick this up to 20% for the entire 5-year period, and they get to say 4.5 billion of revenue, so probably doable for a company like Boohoo if they're going to expand internationally, then it's even more undervalued, 28% undervalued. So I really want to take some time to understand both of these businesses, understand, what's their addressable market looking like, how quickly are they set to grow over the next 5 years, because I do think there is an opportunity here with Boohoo. And now the next company we're going to look at is Asos. Very similar company in nature, slightly bigger in terms of revenues. You can see here they're actually currently doing 3.26 billion of revenue. Gross margin is pretty much the same as well, though, at 47%. So similar companies, but take a slightly different angle on what they do. Again, they are a fashion retailer, but they've been around a little bit longer than Boohoo. They're a little bit less contemporary and modern in their fashion, is probably the way that I'd put it. But I sort of prefer that in a sense, because who knows how long this new fashion, or edgy fashion, let's call it, is going to be around for. I think Asos is much more to do with buying low-cost clothes. Again, they're taking a similar approach to buying up, a lot of the retailers that have struggled in the past year with the coronavirus. They bought Topshop and Top Man, which are obviously big retailers in the UK. Miss Selfridge as well. So they're another company that has a portfolio of brands. Some of them were brick and mortar retailers, and they're now taking them online and trying to make it an e-commerce play. Asos are similar to Boohoo in the sense that they're a first-party e-commerce and retailer platform where they provide all of the logistics and fulfillment infrastructure themselves and actually sell direct to consumers rather than being a marketplace. But what they do actually do that Boohoo doesn't is they offer different brands to their own, or different to the Asos only brands, and allow other brands to be sold on their platform by way of Asos purchasing stock from them and then reselling it to consumers. So they actually get a discounted price and then sell it on to consumers. So it's a slightly different business model in that sense, but very similar in terms of the economics and how they work. And looking at Asos's results, they've had slightly worse results than Boohoo, but again, this was a bigger company back in 2016. They were doing 1.4 billion of revenue already, and they've grown that to 3.2 billion. Again, a lot of it's been organic growth, a lot of it has been acquisitions as well. They're a lot more reliant on the UK and Europe than Boohoo are, so they haven't got the same US presence as they do, but they are a lot bigger in the UK and Europe, especially some of the areas in Europe. I think that's going to be a good area for growth for them in the next few years. But similar margins as well, so sitting around 5%, net income slightly lower at around 3.5%. Free cash flow though, good free cash flow numbers. Actually 11.5% free cash flow margin as of the most recent year's results, which I think must be a slight anomaly, because that's makes it around an 8% free cash flow yield at the moment. So that's a very good return on the investment. And interestingly enough, their market cap hasn't moved much in the past 5 years, which probably is a little bit of a concern for some people looking at Asos on the face of it, especially if you look at their stock price. It's been a bit of a bumpy ride, to say the least, over the past 5 years for Asos. And the reason being is that the valuation's just run away with itself, really, on a few occasions in this stock's lifetime. And a lot of that is because it was one of the first, big e-commerce plays, fashion e-commerce plays in the UK. It was one of the only ones, only decent ones for a long period of time as well. So I think the valuations got away with themselves. As you can see, the PE back in 2016 was around 181 and then 89. They didn't quite live up to the growth expectations as well. So only getting 30 and 25% growth rates on 181 PE, you can do the math there. That's not going to work out very well for the shareholders of that stock if the market starts to come down to a more realistic valuation. And I think we're near that realistic valuation now. A PE of 40 times, probably quite rich for a company growing at 20%, but EV to EBITDA 24 times. So very similar multiples to what we've just seen with Boohoo. Obviously, the free cash flow yield of 8% is fantastic, but I do think this year of free cash flow is a bit of an anomaly. They didn't have to spend much on CapEx, but a lot of cash from operations, which is good to see. I wouldn't want to project a 10% margin going forward. Talking about going forward though, I have again taken some conservative growth estimates, estimated 20% out for next year, and then drop that down to around 12 and 10% for the following years. This gets Asos to a figure of around 6 billion in revenue by 2025, which I think is more than attainable for them. And then just for the sake of demonstration, like I said, I'm screening these stocks at the moment just to get an idea of if it's worth investigating them or digging into them even more. I've taken exactly the same average margins on an earnings and free cash flow basis as we've seen in the past 5 years, and I've just projected that out to 2025. And with a terminal value multiple of 25 times, just a very cliche multiple there of 25 times. I could be being a bit more conservative if I wanted to be, but I think 25 times is fair. It's around about what it's selling for now. And then that gets us to a market cap of 8.5 billion in 2025, which is around about a double from where they are now, just shy of it. And with a discount rate of 15%, that means the intrinsic value for Asos would be 4.5 billion today. So showing Asos as 4.8% or 5% undervalued, give or take. Fair price for it would be around £50. Again, I know this is in dollars. I'm just so used to covering US companies, so sorry about that. But £50 or 4.5 billion for the company. Not much of a margin of safety, but I think our growth estimates and no margin improvements are conservative enough to give us some idea of a margin of safety. Of course, this is just a screen at the moment. So you may think, what's the point in both of these companies? Why are you just being too conservative? Why are you dropping down the growth rates? And just to reiterate, the point of this at the moment is to screen these stocks based on what they've achieved on the past. All right, if they can perform anywhere close to what they've done over the past 5 years, if the market looks like it's heading in the right direction, and the numbers make sense as well. So if we can conservatively get to a good value for this business, then it may well be worth opening a position in the stock. But it's still early stages for me on this at the moment. But I will continue to look into both of these companies and report back. Maybe do another video on both of them. I'll try and get one on S4 Capital out as well, actually doing a deep dive into the business and everything else so we can cover these companies in a bit more detail. I'll also be adding these valuation models to the Patreon page, so you can go ahead and check that out and you can change some of the assumptions to see what sort of fair value you would put on both of these businesses. I'll also add them to the watch list of stocks that we're keeping on the Patreon page as well, which tracks all the stocks we've covered here on this channel, tracks their fair value against their current market price, so we can see which stocks that we've covered are the most fairly valued at the moment and may be worth us looking into. So I'll add both of these to that. Go ahead and check that out if you're interested. I'll leave a link to the Patreon and the Discord in the description. If you could leave a like if you enjoyed the video, I'd appreciate that. I know it was a bit longer than probably I'd expected and any of you expected, but hopefully it's a good screen of these two stocks that you may not have heard of before, especially if you're not from the UK or not familiar with the UK. Put another 2 quality businesses on your watch list to keep an eye on. Comment, let me know what you think down below. I'd be open to any feedback or any ideas if anyone knows any more than I do about Boohoo and Asos. And subscribe to the channel if you haven't already. I will see you all in the next video. Good luck with all of your investments.